Hi, I'm Max Keiser. This is the Keiser Report. The word is supranational. Supranational. Hey, you know what that word means? It's the new word all over Europe. It's really important. It means loss of sovereignty and all kinds of bad stuff. But let's get more details from Stacy Herbert.
Max Keiser. Merkel pushes for European fiscal union. The article points out, what does fiscal union mean exactly? There are different interpretations, apparently, Max. Merkel wants the European Commission to have a veto over countries' tax and budget plans, whereas the French want national parliaments to be involved. But remember, Max, in episode 217 of the Keiser Report, we quoted the Élysée Palace speaking on behalf of Nicolas Sarkozy. He said, quote, "The president has in no way the aim of giving supranational powers to the European Commission. We want to discuss the ways of creating more intrusive powers for Brussels to monitor countries such as Greece."
Right. It's all being kicked upstairs to supranational powers.
Yes, but only for certain people. There are the Jim Crow laws being applied towards the EU. There are certain people, they commit crimes, they're bad, they get thrown in jail. Others commit crimes, they get bumped up to the headquarters of Greece, they run Greece, or they run Italy. You know, they get appointed to positions of extreme power once they commit big enough crime.
Okay, so you're making an interesting point there. In other words, as they move the fiscal and monetary facilities up a notch to supranational powers, they're also abandoning all the local laws governing various countries that would create some kind of justice system within those countries. We're moving toward a two-tier system, both financially and all across the legal spectrum entirely.
Germany and France won't have to give up their sovereignty. But Greece, Italy, Portugal, Spain, certain people will. There's a two-tier Europe emerging, just like we see within each society where the 1% is taking more and more of the wealth, never having to pay for their own mistakes. And we see that, Max, with France and Germany in this case. Their banks have been more reckless than almost any other banks across Europe. And yet their banks are constantly being bailed out, and yet their countries have to never give up any of their sovereignty.
Okay, so French and German banks, the most reckless, therefore they give up less of their sovereignty versus the rest of Europe. However, there are even more reckless banks in the UK and the US, and I assume that they'll come in and destroy France and Germany's sovereignty at some point.
Well, Max, we were talking about reckless lending. Well, look at some feckless people here in this next headline. Feckless parents would only spend extra benefits on themselves, said Ian Duncan Smith. The Work and Pension Secretary for the UK, Ian Duncan Smith, otherwise known as IDS, said that extra money provided to dysfunctional families may simply be spent on drugs or gambling rather than on helping children, so we won't give them any more money. And he's responding to this survey that says that there are 100,000 more children living in poverty now.
Well, this idea of fecklessness, trying to characterize the people as being feckless, the people who put you into office, the people who pay your wage as a bureaucrat, is misplaced, obviously, especially in the context of a city of London that has redefined fecklessness and irresponsibility to really incorporate levels of wealth and larceny stealing that is almost unimaginable.
Well, let's go to google.com and I'm going to check out what the definition of feckless is. Adjective of a person lacking in efficiency or vitality, unthinking and irresponsible. And synonyms proposed, Max: powerless, ineffective, helpless. Powerless. That's important to note because these feckless people he's referring to are powerless. They're the powerless people in society. They're not the powerful. The powerful are the ones that are reckless.
I was never impressed with this Ian Duncan Smith character. He's not even worth raging against. I mean, George Osborne, yes, David Cameron, maybe, but Ian Duncan Smith, he's such a minor player in all of this. He should be in the back bench, not even in Britain. He should be in the back bench in Lithuania somewhere. The guy's a complete bureaucratic nobody.
Well, as I was saying, that he was referring to these 100,000 more children now living in poverty. Ministers claim that the official measure of poverty, households earning less than 60% of the median income, does not reflect a proper approach to tackling the problem. It is now expected that the government will change the definition of poverty.
That always is the case. We're living in a revisionist age where if a bank breaks the law, they change the law. If the government is failing to do what they were elected to do, they change the definition of what it is they're supposed to be doing, or they change the statistics that they are reporting to somehow reflect them in a better light. Then they get Murdoch, who's completely corrupted, to propagandize all this fake information from the government and all these fake statistics and all these new redefinitions and revisionisms. And no wonder people are sitting there back home thinking about, you know what, within 5 minutes from now, I could be looting that liquor store and walking away with 50 pounds that I deserve.
And now let's again look at this two-tier system that we see around the world, but especially in the UK. Ian Duncan Smith, the government has saved more than £100 million in benefit fraud crackdown. A quote from the article by Ian Duncan Smith: "We prosecuted almost 10,000 benefit fraudsters in 2010-11, up from 8,200 the year before. In all cases, benefit fraudsters are required to pay back the money that they have stolen." Now, Max, can you tell me how many bankers have been arrested in the City of London?
0.
How many have been prosecuted?
0.
How many have paid back their ill-gotten gains?
0.
Exactly, and you can see that in this next headline. Money found in Britain may belong to MF Global. About $200 million in customer money that vanished from MF Global is believed to have surfaced at JP Morgan Chase in Britain, according to people briefed on the matter. Now remember, okay, they found $200 million. That's the equivalent of 127 million pounds. So here you have 127 million pounds right there in this account. They haven't prosecuted one single person to try to get that money back. Instead, Ian Duncan Smith prosecuted 10,000 Brits to get back less than that, 27% less than that. Regardless, it is unclear whether investigators can recover the $200 million.
All right, so Ian Duncan Smith slams 10,000 benefit claimants for stealing the equivalent of a soda pop in his imagination versus MF Global and JP Morgan, which have actually, without any equivocation or doubt, has outright stolen millions, hundreds of millions of dollars, and Ian Duncan Smith and all the other Tory frontbenchers are sitting on their hands hoping that they get patted on the head from these bankers and thrown a little bone. Good job, David Cameron.
I'll read this quote, Max, from the article. "During MF Global's last chaotic days, the brokerage firm overdrew an account at JP Morgan. Some investigators now believe that the firm used customer funds to patch at least some of the hole, which would have been a significant breach of federal law. Nobody at MF Global, including John Corzine, has been arrested. Over in the UK, authorities are looking into whether JP Morgan initially questioned the source of cash and sought proof from MF Global that it was complying with regulations. Now, any of those 10,000 people prosecuted by irritable bowel syndrome, any of those 10,000 had tried to transfer $1,000 to a bank account, you can bet your bottom dollar that JP Morgan would have interrogated them, would have anally probed them, looked at every single orifice to try to find out where the heck they got that money.
Yeah, I think that that's a safe bet, that they would be probing their orifices, looking for that money, because this is how, in fact, they make money. They probe the globe's financial orifices, and they root out all the detritus that they find there as collateral for $500 trillion, which are the basis for Jamie Dimon's Christmas bonus. Happy Christmas!
Well, okay, and now Ian Duncan Smith also said about these poor people that they're feckless, and so we shouldn't give them any more money because they'll only spend it on drugs and gambling. The same week, of course, we've had trillions of new liquidity introduced to the system for the banking class, right? Because, of course, they're so sound and reasonable and sane with their money. Social media snake oil. How much will you buy? This is from your guest upcoming, and this is Josh Brown, downtown Joshua Brown. This Groupon IPO was a disgusting scam designed by the underwriters to present the appearance of a hot deal so that they can get Mark Zuckerberg's attention for the real IPO coming next spring. Share counts were kept low for the media to see a pop, and then backs were turned as the market cap was cut in half over 24 days. Everyone involved should be ashamed of themselves.
Well, we've been covering this for weeks. Groupon is a Ponzi scheme. All the original customers have dropped out. They need new customers to come in. None are coming into it, so they went public. There were a lot of people who tried to flip the stock. Hedge funds tried to flip the stock. Not even the flippers were able to flip the stock fast enough. It was such a catastrophe on the initial public offering. All the underwriters involved, including Goldman Sachs, of course, they got their investors in ahead of the IPO, knowing that it was a Ponzi scheme. And now we're going to move on to another Ponzi scheme called Zynga, which is a virtual currency play. That's a Ponzi scheme, and there's 3 more of these coming down the pike. Facebook, I would imagine, by the time it goes public, will be overvalued substantially. I think Goldman Sachs thinks they're going to get $100 billion for this. Remember, they got $50 billion priced when they brought in their customers illegally under SEC law, but not that they have to comply with the law ever.
Joshua Brown goes on to ask, as though coupons delivered electronically and unprofitably is some major advancement of human civilization worthy of being priced at 5 times sales? Are you people high? So again, you remember Ian Duncan Smith called these feckless poor people that they would just misspend the money on drugs. And here Joshua Brown is asking, are these investors that chase these crazy IPOs with no business model higher, are these people high? And of course they are. They're high on Fed cheap money, on moral hazard. They're high on knowing that they're always going to be bailed out for their bad bets.
Look, those Somali pirates have the right idea. They loot the ships, and then they sell shares in the next ship that they're going to loot on an informal exchange like a Groupon or a Zynga or a Facebook share market or Shares Post. It's like an electronic internet-based market that only people who actually have a proven record of criminality are eligible to be involved with. And they take those public, the Somali pirates. So, I returned to these looters in London just a few months ago. You see, they need to take themselves public. London Rioting Looters Limited.
Yeah.
They should go public on the alternative investment market, the AIM. They should take themselves public. They could raise, like Groupon or Facebook, they could raise a quick $20 billion. Then they would go in and they would buy out, let's say HSBC or Barclays, buy out these banks, fire everybody, and have your way with them. Whatever that means, throw them out the window. We don't care. They're useless at that point. And just replace the entire city of London with real professional looters, not these amateur looters.
Having your way with them implies something different, I think, in the UK.
Well, everything is slightly different in the UK because of all those public school boys, isn't it? Okay, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Downtown, Josh Brown after the break, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to New York City and speak with Josh Brown of thereformedbroker.com. Josh also works with Barry Ritholtz over at Fusion IQ, an online quantitative research firm. Josh Brown, welcome back to the Keiser Report.
Thank you for having me. Great to be on.
All right, Josh Brown, you write, quote, this Groupon IPO was a disgusting scam. Tell us more.
Well, if you just look at, for starters, the structure of how they concocted it, the whole goal was to present an image that this was a quote-unquote hot deal. How they did that was they limited the amount of shares they were going to allow to trade, and this enabled them to get a much higher price, a much higher valuation up front. It created an artificial sense of scarcity, led to investors chasing it on the first day. They got it up to 30. Last time I looked at it, it was 15 or 16 bucks, and we're talking about 25 days after it IPO'd. So essentially it lost 2% a day from the day it came public. And the only reason that was able to happen was because they priced it way too high and they made it way too scarce or artificially scarce. And I think it's just indicative of the fact that these games continue to be played. Nobody is at all cowed or humbled by anything that's gone on since the credit crisis.
Well, what struck me about the Groupon IPO is something remarkable in that something like 85% of the original investors had sold out almost all of their stock before the IPO. Typically, an IPO is when insiders or venture capitalists have a chance to cash out some of their money. But in this case, almost all the money was already cashed out. The CEO cashed out for over $1 billion even before the IPO. This seems to be a new chapter in the IPO scandals going back decades.
Without a doubt, there's something called second market that in theory is a good thing because it's providing liquidity to early stage companies. It's allowing people to trade shares with zero SEC oversight on an exchange where regular investors are not permitted to tread. It's really only people that are qualified to be there, whether by virtue of how high their net worth is or whether or not they're an insider in one of these companies. So essentially they're arranging for buying and selling in a market that is not an SEC registered market like the New York Stock Exchange, like the NASDAQ. Now, there is a good part of that, but there is a bad part of that. The good part of that, again, it facilitates liquidity. It allows for early stage companies that ostensibly could be job creating companies like Facebook to have employees be able to buy and sell shares. The downside of that, of course, is the dirty money has gotten involved. The dumb money is going to follow them in. And what you're going to end up seeing is a situation where essentially we have shadow markets once again where only the elite, the privileged few, are able to take advantage of everyone else. I think if you look at Groupon as an IPO, it's barely an IPO. They sold 4.1% of the company to the public, which is, it may as well not even be public. And again, as you pointed out, a lot of the early investors, a lot of the wheeling and dealing had already gone on prior to the listing. The sole purpose of the listing, in my opinion, was to get a big high valuation for the company, to make people feel better, and to get Mark Zuckerberg's attention so that the Morgan Stanleys of the world have a shot at getting the Facebook IPO. They want to basically say, see what we're able to do? When it's your turn, hire us. So it was almost like an advertisement.
Right, we'll get to that Facebook IPO in a second, but I want to talk about this Groupon a little bit more. So on the subject of IPO scamming and scandals, it was only 10 years ago or so during the dot-com bubble and burst that a lot of the scandals were revealed. I remember Frank Quattrone, I believe he was at Credit Suisse at the time, was caught laddering an IPO stock.
He's back, by the way.
Okay, so at the time, and I believe he got off in front of a jury because his argument was that my crime is too complicated for the average jury to understand, therefore I'm innocent.
That's what, brilliant.
Yeah, and so laddering an IPO, this is of course when the bank taking the company public will participate in that secondary market, being a buyer in that market, creating an artificial price stimulus to bring in more suckers at an even higher price, all the while they're playing games in the back end. But what about the financial press? Because I know, like Business Insider, which has got to be the most widely read internet business site these days, was really a cheerleader for the stock. I mean, Henry Blodgett wrote a couple of pieces that seem ambivalent about it. He was saying, well, maybe it's a Ponzi scheme, maybe it's not a Ponzi scheme. Clearly, it is a Ponzi scheme, but isn't there some responsibility for outlets like Business Insider for having participated in this massive ripoff?
Let's take the two issues separately, if I can. The first, is it or not a Ponzi scheme? It depends on how you want to define Ponzi scheme. Essentially, the way Groupon is operating is they're taking in money from merchants, from the sale itself, and they're not paying out the merchants for 60 to 90 days. That 60 to 90 day window where they're holding onto the cash allows them to hire more people, bring their services into other cities. So they're creating growth just by virtue of the fact that accounts payable haven't gone out yet. So the only way this thing continues to grow is if they can roll out into more and more and more cities. At a certain point, you hit a limit where there aren't enough merchants that are interested in participating, there aren't enough people willing to take the coupon and use it, or there aren't enough people that are willing to be employees of Groupon in a new city. So ultimately, we know this growth will hit the wall. Exacerbating that fact, you've got a lot of competitors. There are zero barriers to entry. Facebook will get into this game. Amazon already is. They're backing Living Social. There are going to be 50 different Groupon clones all over Asia. So, they had this head start. They kind of had this name brand recognition, but they have to essentially act like a Ponzi in order to keep that level of growth. I don't think they're intentionally trying to play accounting games at the company. I just think it's a poor model. Let's put that aside. Does Business Insider have any kind of responsibility whether or not they're going to cheerlead it? I don't know. I don't know that we're calling them journalists. I have friends over there. Henry's a friend. Joe Wiesenthal's a friend. I think what they do is they present every viewpoint. So if Henry's saying something positive about Groupon and they're doing 1,600 articles every 3 days, it's pretty it's pretty certain that someone else blogging for the site, whether it's an outside contributor like myself or one of their internal bloggers, is going to write something that's a counterbalance.
Yeah, let me follow up with a couple of points. First of all, in the case of Groupon, the original merchants who participated, the rate of re-participation is falling down to 0. So this has been
also indicative of a possible Ponzi.
That's my point. In other words, you need new suckers to make this work. If the original merchants found this to be a valuable service, they would sign up again, and this would be a viable model. But they're not, and this has been clear now way before the IPO. And second of all, regarding Blodgett at Business Insider, I mean, here's a former institutional investor. I don't know if he ever made it to their all-star list, but he was certainly a big wheel on Wall Street. He and Mary Meeker were the two primary dot-com analysts in the 90s who were really the axe in the dot-com space. He has a reputation for knowing better. I don't know if I buy the fact that we can just assume that the doubt that he's just a blogger who doesn't know, any better.
In Blodgett's defense, they're not selling securities at Business Insider.
Right, but they are selling quasi-research. But okay, we'll let him speak for himself. I invite him on the show again. So let's move on. The former Treasury Secretary Hank Paulson, formerly of Goldman Sachs, tipped off some hedge fund managers, also formerly of Goldman Sachs, about then pending nationalization of Fannie Mae and Freddie Mac. And there was a lot of price action in those two stocks, and a lot of people made a lot of money on inside information. Your thoughts?
First of all, what the hell did Hank Paulson think his job description was in the summer of 2008? I mean, I've heard that question asked by others. That's really, what is he doing? Is he using these ex-Goldmanites who he trusts as intelligent people as a sounding board? Is that why that meeting is taking place? Because I can't imagine it's explicitly a meeting about, guys, here's what you need to know is about to happen. I genuinely can't imagine that anyone would be that stupid, especially someone who was an insider for so many years at an investment bank. They all know the rules. I don't know, and I don't know if anyone knows whether or not the hedge funds that were in that room or others that may have communicated with them placed any trades based on that. In fact, in one case, one of the hedge fund managers called his attorney. The attorney said, don't trade. But here's the deal. When you're talking Fannie and Freddie, you're talking about paper. You're talking about bonds and preferred stock and common stock that everyone on Wall Street has some kind of exposure to. In other words, you don't have to walk out of that meeting with Hank Paulson, hear that Fannie and Freddie are in that much trouble, and short Fannie or Freddie securities in order to express that viewpoint. You can short any of the regional banks whose balance sheets are stuffed with Fannie and Freddie bonds and preferred stock. You can short any of the money center banks. There are a lot of different ways you could have traded that are so indirect that it would be impossible to trace whether or not you took action on that. So I don't know if this is going to be something that we just say, oh, this is how it works, nobody's surprised, or if there's actually something where, regulators are going to take action. I just have no way of knowing, and I don't think we know what those hedge funds did on the heels of that meeting. It's disturbing either way, Max.
Well, we know that Paulson, as former head of Goldman Sachs, or co-head of Goldman Sachs, has at least some familiarity with the rules as stipulated when one acquires a Series 7 broker's license exam was passed, and you acquire the license. But I mentioned that because John Corzine, who just committed massive fraud at MF Global, apparently he didn't even have his broker's license renewed. He went into that job without having an actual license to do that job. Any thoughts on the MF Global scandal?
He's grandfathered in.
He's not grandfathered
when you're John
in. As
Corzine,
you know,
don't need a license.
Those licenses expire without renewal every 2 years. How do you see that playing out, the MF Global scandal, Josh Brown?
We don't yet know if it's massive fraud. A lot of the money that they said they were having trouble recovering, the counterpoint to that is it's not that it's fraud, it's that the books are a mess and the accounting is a mess, and we'll find it. We don't know yet. I have clients that have been affected because they've been trading gold futures and things with MF Global away from me, so I have heard about frozen funds, and of course it's horrendous. The other thing that Corzine's defense will point to, and it's amazing how these guys can find the one loophole that allows them to blow themselves up. They really ought to be congratulated for this. It turns out that you can commingle customer funds with the funds of the firm in only one specific instance, and that is if you're involved with the securities of a sovereign issuer, whether it's a U.S. Treasury bond or a European. So in that specific case only can there be, I know they don't use the term commingle, but that's basically what they've done. So it turns out that they're so brilliant that they found the one loophole that would destroy the entire franchise within 6 weeks.
All right, so listen, we're out of time. Before I go, I want to tell people about your Twitter feed because it's very active and it's full of great stuff. And aside from your website, Reformed Broker, which is also good, but your Twitter feed, what's your Twitter handle again?
It's at Reformed Broker.
All right, we're out of time. Thanks so much, Josh Brown, for being on the Keiser Report.
Thank you.
That's all the time we have for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Josh Brown. You can follow Josh on Twitter at Reformed Broker. You can follow us on Twitter, on Facebook, or Keiser Report, or you can send me an email, keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.